All right, everybody. We're going to talk about chapter 21 right now. A couple of things. When we talk about manufacturing overhead is basically all these indirect costs. We've talked in previous videos when I'm creating a sales price for something. I know my direct material because I know basically I pay for the invoice. I know what goes inside of it. I know the labor cost because I know the number of people multiplied by the hours really rate that I'm paying them. Third bucket is the manufacturing overhead. Manufacturing overhead you can think of it as all the indirect costs associated with the product. So for example, the screws, nuts, bolts, varnish, all these indirect costs that it's not directly traceable to a finished unit. Now, and you think about like screws, like if I'm making a table, you know, if I think about the table, right, I got table legs, those are going to have a real cost to it. The tabletop will have a cost as well. But you still have to have the screws and the varnish and all that. And it's going to be a very difficult task to go back through and determine how many, basically the cost of the screws you put into something or the varnish. Because normally in a manufacturing environment, you buy screws in like a 10-gallon container. You get a big thing of screws, it's like thousands and thousands and thousands. You don't really want to be able to weigh it out and measure it and count each one and say, okay, I paid $100 for this 10 pounds of screws. 1, 2, 3, 4, 5. You don't want to count them out. It's going to be too much effort. It's going to be too much time burden. Because keep in mind, you know, one of the key parts of accounting is that we look for those efficiencies. I've had people who work for me and they're like, oh, well, I spent 3 hours looking for 25 cents on the bank reconciliation. And I'm looking at them, it's like, well, why? You know, it's a quarter. And what they've done is they've spent 3 hours of their time, which, you know, whatever, pretend they make $20 an hour, they've spent $60 of time looking for a quarter. All right, not efficient. I know some people really pride themselves in tying things out to the penny, but in all reality, practical application, we don't do that. Right? We look for the biggest bang for our buck. We focus on the big wins. We focus based on the key drivers. We don't worry about the pennies or the 2 cents and all that. And I know there's going to be somebody which says, look, the pennies add up. Well, they do add up eventually, but when you're talking about thousands and thousands of dollars, a penny is just really just rounding. So we just have to be very careful, you know, that we don't go too deep down the rabbit hole and looking for pennies. And the same thing goes for the manufacturing overhead. We focus on the big dollars. And when I have manufacturing overhead, right, we talked about the screws, nuts, bolts. You know, if it's a tenth of a cent, it's fine. I'm going to account for it. But what I do with manufacturing overhead is if it's not direct material, it's not direct labor, I aggregate all those costs in one big bucket called manufacturing overhead. Now, I still have to get this manufacturing overhead cost back to a product line. And what I want to do is I want to do something what they call allocate. And allocate is the same thing as spread. So I take all these manufacturing overhead costs. And we talked before, it's basically indirect labor, it's indirect materials, screw, nuts, bolts, varnish. It's the maintenance of the people at that facility. It's the depreciation of the equipment related to production. It's all those costs that we can't directly attribute to a particular line. We aggregate all these together, and then what we do is that we spread the cost. That's really ultimately what we do. We go back through, we spread the cost across everything. And we do it for a couple of ways. I can allocate based upon labor hours, I can allocate based upon material cost, I can allocate depending on sales price. So I'm just going to find some methodology, some reasonable methodology, and I'm going to spread all those costs across everything. That's really what it's going to be. So I'm just going to take this big bucket and I'm going to spread it job 1, job 2, job 3, job 4. I'm just finding some logical methodology and I'm going to spread it in those fashions. So we allocate those costs back to a particular job. Methodology, I mean, every company has different methodologies. You know, you just find one that works and support that one. Now, what we also do when it comes to manufacturing overhead, it needs to be reviewed constantly because manufacturing overhead is kind of like this big catch-all. So there's some stuff that when I originally established my price, you know, there can be some new costs that creeped in that we didn't expect about. In prior chapters, we talked about equipment and depreciation, but keep in mind the big thing when it comes to equipment, there's a cost of maintaining it. right? Either I have preventive maintenance, which means I'm sending somebody out every 2 weeks, every month, every year, keeping an eye on it before it gets into problem. Or my worst case scenario, I have a maintenance team that I keep on staff. And the maintenance people, their overtime, their costs, all those do belong inside of manufacturing overhead. So as equipment gets older and older, it's going to cost me take more time to repair. There's going to be more worn out bits and bolts and screws and everything else kind of associated with that. So we just have to be very careful. You know, we have to keep a very close eye on our manufacturing overhead, because there's going to be costs that creep in. There's things that we didn't originally anticipate. There's always going to be something which will come along, additional cost, and as soon as we identify this additional cost, we call it out. We say, look, you know, we thought we will get $50 margin on every single unit I sell based upon my original cost projections. However, I'm now having to spend more money on maintenance. I'm having to spend more money on the material because material costs, we talked before, will go up. That just does. And all these costs, every cost that we have eats away at our margin. And of course, we've also talked previously about we have to continually, for the most part, lower our sales price to remain competitive, because other people is going to come in the marketplace that we have a good idea they're going to join in as well. So we have to continually monitor every aspect of the cost. So very important to keep in mind. And also the allocation. In chapter 21, chapter 21 does a pretty decent job on going over some of the journal entries. And all we're doing with the journal entries in chapter 21 is just really walking it before. You know, we talked, said, hey, here's raw materials. Everything comes in. Raw materials, if I add the labor to it, if I add some manufacturing overhead, it will then turn into a work in process, right? A work in process. It's started, it's not finished, I can't sell a work in process. Add more labor to it, I take more overhead cost, and I finally do have that finished product that I can sell. But the journal entries and what we see inside of 21 is really just walking it through different parts of it. Some of the key journal entries you're going to see is just on page like 922. It's really talking about moving costs from inventory cost to work in process. So example, we have one which is a debit to work in process assembly and a credit to raw materials inventory. And what that's doing, that's decreasing your raw materials inventory, increasing your work in process inventory cost as well, right? So it's basically moving it from bucket to bucket, and you'll see journal entries, which will take it from, you'll see debit to finished goods, a credit to this work in process assembly. Then once you'll see your final entry when it's done and we sell it, it's just going to move it to a cost of goods sold. So your book does a really great job inside the journal entries and knowing that's just what the whole point of it is, walking from one place to another to another. But what we have to really do is we spend a lot of time just really monitoring our cost, because every dollar additional cost we incur, we're losing that dollar margin. So we have to continue to evaluate and reevaluate. All right. One fun side note that I think I addressed in the previous video, but I'm not sure on that part. Treasury stock. I know treasury stock's related back maybe about 5 chapters ago, so just a little bit out of sequence on that one. Treasury stock in its own self. Why do we buy? Why does a company buy back its shares? And the book did a really great job explaining it. But while we're doing this, we go back through, we buy our shares back because we think our stock is undervalued. A company can go through, traditionally the way you think about a company, it's total assets minus liabilities divided by the number of shares. It's really open, and that'll give you an idea of what the value of the stock price should be. And what will happen is if we see this as massively undervalued, what we as a company will do, we will go out to the marketplace and buy those shares of stock. We will buy stock. And of course, it's all about supply and demand, right? If I am reducing the amount of supply that's out there, the shares that are remaining, people want, and they're willing to pay more for. So what that does, that naturally increases my stock price up to where I would expect it to be. After people, we leave it there for 6 months, 3 months, a year, some period of time, and we really get that consistency, we start selling back some of our treasury stock. And what we do is we sell it back in very small increments. We just don't flood the market with it. Small increments back out to the general public. And what will normally happen if we put sell our treasury stock back in smaller quantities, what will happen is that it will have a very small blip, small decrease on our stock price. So really cool stuff. It's just about making sure that our company is properly valued and people understand that. All right, have another video probably later on today or first thing tomorrow talking a little bit more about the manufacturing side of the business. All right, bye-bye.